Other news we're following, the gavel coming down on the worst week since August 2016 for European stocks. Wall Street opened the session earlier in positive territory. Those gains have since been erased. The drop comes amid signs of growing wages, rising interest rates, and as you can see, another down day for Europe. Well, for more, we're joined by Helal, Miah, analyst with UK stockbrokers, the Share Center. Thank you for speaking with us here on France 24. Is this just a normal correction, or should we worry?
Well, I think you've got to look at the last 18 months or so that we've had, and we've had a phenomenal rally into the markets, led by the US, and simply because we've got very good economic growth out there in the US, and Europe is following suit. We've had a huge amount of quantitative easing and stimulus, and Europe is beginning to see economic growth come through. So naturally, you'd see shares rally quite well. But I think the big question has to be whether the markets have rallied too fast, too soon, and I think that seems to be, answered this week. I guess to a certain extent it has rallied too fast, too soon, and there are a few concerns with investors out there in terms of where interest rates go, and there are some key economic pieces of data coming out. Last week we had the wage rate in America, and next week we'll have inflation coming out, and that will give us a key as to where policymakers in America thinking the interest rates will go.
All right, so the economy, the real economy, is robust, but it's stockbrokers are paying attention to what could be the end of cheap money that we've seen since the financial crisis. The end of cheap money, will that slow this recovery that we've seen?
I don't think so. I think the fundamentals still look very good. You've got very low unemployment in America. Unemployment in Europe is reducing. The emerging markets are doing very well, and China is going to fall off a cliff. So I think you look at the global economy, confidence levels, they're still relatively robust. I think it's a case of, where the market is fearful is whether policymakers are going to react too aggressively. And so markets are really looking at the future path of interest rates and whether it's going to be too steep or not. Ultimately, we would expect policymakers to err on the cautious side and not to derail the economic growth. But I don't think markets should be too concerned that the stock market will infect the global economy.
All right. Hello, Miah, analyst with UK stockbrokers, the Share Center. I want to thank you for joining us.